Investing in high quality dividend growth stocks is a great way to build wealth long term. Buying low and selling high is the name of the game. But even more importantly is how patient you are with your investment and allowing your hard-earned dollars to work for you. Work while you sleep. Far too often, new investors, really any investors, let emotions creep in and sell way too early. Investing in dividend stocks that are increasing their dividend each and every year allows for the power of compounding to work in your favor. Albert Einstein once said that the power of compounding is the eighth wonder of the world. Here is how it works. Let's say that you own 100 shares of a particular dividend stock, a dividend growth stock. That company will pay you a dividend, an annual dividend based on the amount of shares that you have. But the next year, once you receive that dividend, you reinvest it into that same stock, and instead of having 100 shares, let's say now you have 101 shares. And that same year, the company increases their dividend. So not only do you have more shares than you had the previous year, but the company is also paying a higher dividend per share. And then we go on to the next year. Now you have, say, 103 shares, and the company yet again increases their annual dividend. And you can see how this snowball starts to work in your favor, and your dividend income increases each and every year. And with that being said, make sure that you stay tuned throughout today's entire video, because we will be talking about 3 high quality dividend growth stocks that are trading at a cheap valuation. Hey everyone, Mark here, and welcome to my channel where we talk everything dividends. If you like the idea of building passive income and earning money while you sleep, then definitely make sure you hit that subscribe button down below and the notification bell so you are notified anytime we drop a new video. Also, if you're looking for a great new investing platform, then definitely check out Webull. I use Webull myself, but right now they're running a special promotion where they're going to be giving away up to 12 stocks valued up to $30,600. This is just a limited time promotion. I will put the link down in the description below, so make sure you take advantage of this awesome promotion. Warren Buffett once said that price is what you pay, value is what you get. Another famous Buffett quote was, "It is better to buy a wonderful company at a fair price than it is to buy a fair company at a wonderful price." It is always important that you focus on high quality stocks, whether they're paying a dividend or not. Always focus on quality. And today we are going to be looking at 3 high quality dividend stocks that are also trading at a wonderful price. With that being said, let's jump in. The first high quality dividend stock that we're going to discuss today is Starbucks Corporation, stock ticker SBUX. Starbucks currently has a market cap of $98 billion. And right now it seems like they probably have a store on almost every corner out there. Ever since the pandemic hit, Starbucks was hit rather hard. Many of their stores were forced to close and just use drive-through options. But for those stores that didn't have drive-through options early on, they were just completely shut down. China has been shut down for much of the past year and a half, opening here and there, but they went to a zero COVID policy, so they are just now recently starting to open up again. Other issues the company has ran into is staffing issues, just trying to have enough staff in their stores. And more recently, they've ran into employees at certain stores that are looking to unionize. And then lastly, at the beginning of this year, CEO Kevin Johnson decided to retire after 5 years as the CEO of Starbucks. He actually followed the great Howard Schultz, who had 2 prior stints as CEO and bought the company back in the early 80s. But since Kevin Johnson decided to retire, Howard Schultz came back as the interim CEO and is now doing a 3rd stint as CEO of the company and has his work cut out for him. With morale low, combined with operating struggles, as we talked about China being locked down, being the 2nd largest area for the company, this has led to the company falling 28% on the year, and this is even after the stock has climbed 10% over the past month. The company recently reported Q3 earnings that were actually quite encouraging. Total revenues were up 9%, and they brought in a quarterly record of $8.2 billion in sales. Global same-store sales were up 3%. And when you see the word same stores, this is just comparing stores that have been in operation for at least 12 months. So this doesn't take into account any new stores that can ramp up and boost that revenue number. So stores that have been open for at least 12 months or more is considered that same store category. Same store sales here in the US, which is the company's largest market, were up 9%. Active reward memberships, which is a very popular, Starbucks has a very loyal customer base, those were up 13%, and there is now more than 27 million members. Here is a look at the company's US segment, which happens to be the largest, as I mentioned. You can see 9% same-store sales growth, which was made up of 1% more transactions from the same period last year, and an 8% uptick in ticket price, which is expected given the price hikes. The international segment was more of the black eye for the company, as same-store sales for this segment fell 18%, with 15% less transactions, which is expected given the lockdowns that have taken place in China. Starbucks has also been a solid dividend growth stock over the years. Currently, shares of Starbucks pay an annual dividend of $1.96 per share, which equates to a dividend yield of 2.3%. The current payout ratio is 62%, and the free cash flow payout ratio is 54%, leaving plenty of room for continued growth in the coming years. The company has a 5-year dividend growth rate of 15%. Analysts are expecting 2023 adjusted EPS to come in at $3.41, which equates to a forward price to earnings multiple of 24.9 times. Looking at this fast graph chart, the blue line indicates the company's 5-year average, which is closer to 30.5 times, suggesting shares are currently undervalued. The company has been a cash flow machine over the years and still has plenty of headwinds in front of it, but I'm taking this time to accumulate more shares. Considering the stock is trading at a very reasonable valuation, as we see more of China reopening, that is just going to be a further boost to the company. And I'm looking at Howard Schultz to right the ship in terms of partner morale. The second high-quality dividend stock we're going to look at today is one of my favorites, and that is Abbvie, stock ticker ABBV. Abbvie currently has a market cap of $248 billion. The company owns one of the best-selling drugs of all time in Humira, which treats moderate to severe Crohn's disease. Abbvie was a spin-off of Abbott Laboratories, stock ticker ABT, and they became their own publicly traded company back in the start of 2013. Early on, Abbvie was really a one-trick pony, as shares of Humira accounted for roughly 70% of the company's total revenue. But fast forward to today, and Humira accounts for less than 40% of the company's total revenues. And this is the case for a couple of reasons. Number one, Humira has lost patent protection internationally, and for a number of years now, the company has seen drastic fall-offs in sales overseas. And now approaching is 2023, which is when Humira is going to lose its US patent protection. This has been a year that has been circled on many biopharmaceutical companies because this will allow more generic Humira-like drugs to come on the market. The second reason that Humira doesn't make up the lion's share of the revenues anymore is due to the fact that the company has diversified its portfolio. It has a strong pipeline of new drugs that are up and coming and selling well. It has acquired new businesses like Allergan, which it closed a few years back, and it still has a loaded pipeline. It has also done partnerships with the likes of Johnson & Johnson. If you've been paying attention or listening in on any of the Q2 earnings or reading the transcripts from the earnings call, it has been common for many of these companies to pull back their guidance and lower their guidance for the second half of 2022. Many of them see plenty of headwinds here in the second half. And much of this has to do with a slowing US economy. We are technically in a recession now, as we have seen 2 consecutive quarters of negative GDP growth. And when economies slow down or go into recession, many investors like to turn their heads more to defensive stocks, which healthcare is a very defensive sector. Think of Johnson & Johnson or Abbvie. If someone has Crohn's disease, for example, they still need their pills or their drugs. If you're Johnson & Johnson, people still need Band-Aids. They're still going to get hurt. They still need Tylenol. You could get a headache regardless of whether you're in a recession or not. So healthcare is a very defensive sector in general, but especially during times of slower economic growth. On the year, shares of Abbvie are up 3.5%, and over the past 12 months, Abbvie has seen its revenue grow 7%, operating income is up 35%, and free cash flow has grown 13.5% over the past 12 months. The company has been great for investors as they have seen growth from the stock, a high yield, and dividend growth, making it what I like to refer to as an investor's trifecta. The stock currently yields a dividend of 4% with a low payout ratio of 42%. Over the past 5 years, the dividend has a 5-year CAGR of 17.5%, and the dividend has been climbing every year since going public or since the spinoff into its own entity. Analysts are expecting 2023 earnings of $11.93, a dip from this year due to the drop-off expected in U.S. Humira sales, before leveling off in 2024 and returning to growth moving forward, based on its strong pipeline of new drugs coming online. This puts shares of Abbvie at a forward price-to-earnings multiple of 11 times compared to their 5-year average of 12 times. Abbvie is a high-quality dividend growth stock that you should definitely have on your watch list. The third high-quality dividend stock trading at a cheap valuation is STOR Capital, stock ticker STOR. STOR Capital hails from the REIT sector, and if you've watched any of my prior videos, then you probably know that I love REITs. STOR Capital has a market cap of $8 billion, so it's going to be the smallest company that we're looking at today. But just because it may be the smallest doesn't mean it's overlooked. In fact, STOR Capital is the only REIT that you will find in Warren Buffett's Berkshire Hathaway portfolio. The prior CEO of STOR Capital, Chris Volk, mentioned back in 2017 that Warren Buffett was having conversations as he studied the company for over 3 years before making his first investment back in 2017, when he purchased a 9.8% stake in the company for $377 billion. Since making his initial purchase back in 2017, STOR Capital shares are up 35%, and that's even given the huge drop we saw in 2020 and the pressures we saw here in 2022. But those shares that he bought during the COVID lows in 2020, those are up well over 50%. STOR Capital went public back in 2014. It is a net lease REIT that focuses more on middle market companies. When it comes to net lease REITs, STOR Capital, the landlord, owns the property, but many of those typical landlord costs, think of property taxes, insurance costs, maintenance costs, all of those are passed on to the tenants who pay their fair share. STOR Capital recently reported Q2 financials which came in above analysts' expectations. The company reported total revenues of $223 million, which was an increase of 16.5% from the same period a year ago. Through the first half of the year, revenues are up 19.1%. AFFO for the quarter, which again with REITs, we don't look at EPS due to the fact that real estate has a ton of depreciation and things like amortization. We want to look at more of the operating cash flow, which can be adjusted from FFO to AFFO, which stands for adjusted funds from operations. So AFFO for the quarter came in at 58 cents per share, an increase of 16% from the prior year. The company continues to consistently increase its AFFO on an annual basis, which feeds into their growing dividend we will look at in a second. Similar to its direct competitor Realty Income, which is stock ticker O, STOR Capital has a very diverse portfolio. The largest exposure the company has to a top tenant is only 2.9%. And the top 10 tenants make up 17.7% of total base rent. Here is a look at the top 10 tenants and industries. Many other net lease REIT competitors have a different approach to its top tenants, which again makes STOR Capital a little different and more unique. STOR focuses more on full-service restaurants and early child development towards the top of its list, where others like Realty Income or National Retail Properties, stock ticker NNN, focus more on convenience stores and drugstores at the top of their tenant list. Another thing that intrigues Warren Buffett about STOR Capital is their high yield and growing dividend. Being a REIT, one must pay out at least 90% of their taxable income in the form of dividends. The REIT structure often leads to higher yields than non-REIT dividend stocks. Investing in STOR has rewarded investors nicely over the years with a consistently growing dividend that has been well covered by AFFO. STOR is very similar to that of Realty Income, which is a favorite among many dividend investors that invest in REITs, except STOR is trading at a huge discount to Realty Income, making it look very intriguing at current levels. I will soon be doing a video comparing the two REITs. Currently, shares of STOR Capital are trading at a forward AFFO multiple of only 12.4 times, which when compared to Realty Income is trading closer to 18 times. And over the past 5 years, STOR Capital has traded closer to an average of 17 times AFFO, suggesting the shares are very undervalued at current levels. So there you have it, 3 high-quality dividend stocks that are trading at a wonderful price. Definitely take a look at all 3 of these companies for your dividend investing portfolio. And if you haven't done so yet, do me a huge favor and click that like button down below, as that is huge for the growth of this channel, and I greatly appreciate it as it really helps us out. And definitely do not miss that promotion with Webull. I will leave that link down in the description below. Again, I hope you enjoyed the video, and with that being said, we'll see you next time. Take care.